So I'd now like to introduce our next speaker, Meera Bagati. Meera is Director of Energy Market Analysis with NextEra Energy Resources. At NextEra, she focuses on fundamental research on all major commodity markets, including natural gas, crude oil, and LNG. Meera has 20 years of energy experience with a strong background in fundamental research, as well as project and management consulting. Today, Meera will be providing an update on the current state of the energy markets. Please welcome Meera Bagati.
Thank you, Donna. Thanks, everybody. I'm going to be talking about a lot of commodities here, but let me test this first so I know how it works. I see it here on the monitor. Am I supposed to see it there? Oh, here it is. All right. So, just a little bit of background on what our group does here at NextEra. But, you guys know NextEra is a big provider of renewables. Basically, the function of our group, which is market analytics, is to provide management some advice around market risk around all the business sectors that we're involved in. Obviously, we're big into power and renewables, but we also have other business segments. We do electric transmission, we do gas pipelines, we also do oil and gas drilling, believe it or not. We like to hide it a little bit, but oil and gas drilling is also a big part of our business segment. Given the breadth of the industries that NextEra touches, our group is basically providing market risk advice around anything we build, buy, or hedge. So we basically touch the power markets, the crude markets, as well as the gas markets. I'm going to start with the oil markets because many of you know the power and gas correlationship has been talked about for a very long time. But more and more, we've seen, especially through the last few years, there has been a big correlation between oil and gas, as well as associated gas has become a big part of the gas supply complex. So the first slide here kind of speaks to basically the shale phenomena having a huge impact in terms of oil supply. So the chart on the left basically shows U.S. oil growth. So obviously, since 2010, we've seen a huge increase in U.S. oil supply. We've grown from 5 million barrels of oil supply to almost 12 million barrels right now. So a big number in terms of almost doubling of the oil supply number. A lot of that growth has been driven by the Permian oil story, so the blue line in the left graphic. And I'm sure you guys have all heard of the Permian Basin. It basically is a huge swath of area that anywhere between West Texas and East New Mexico. But Permian is a special oil play, and it's very hot right now. We've all heard about it. We've all heard about all the pipelines that are being built there. But in general, the only difference between Permian and some of the other associated oil plays is the fact that Permian is a multi-stacked oil play. So obviously, if a producer drills one wellbore, you're hitting a number of productive oil plays. So obviously, you heard about the Bone Spring, the Wolfcamp. But in general, the Permian, you get a lot more bang for your buck with drilling a hole in the Permian rather than the Eagle Ford and the Bakken. So obviously, there's a story around this whole oil supply renaissance. But in general, there's also a gas story associated with it. So if you look at the right graphic, it just kind of shows that gas production, associated gas production, as a function of the explosive growth in shale oil drilling, is also sort of a game changer for the gas market. So just sort of give you an idea of the numbers from like 2011, we've grown from 1 BCF to almost 10 BCF of gas production growth. And just to compare and contrast a little bit, so we're talking oil supply of about 5 million growth and a gas supply growth of 10 million. So what this is suggesting is that even though a lot of times we end up talking about Permian as an oil play, it really is the associated gas growth number that's double of what you're getting on the oil side that is really causing a headache for some of the Permian producers. And we all saw numbers. If you follow basis markets, gas basis markets, we saw gas basis in the Waha Basin last month or so back like by $9 an MMBTU. So basically, the producers were paying you $9 an MMBTU for somebody to take their gas away. So gas was more of a headache in the Permian play than sort of an added byproduct of value. But really, if you're talking in terms of context, the US, thanks to the shale revolution, has become a huge global crude producer. So if you just look at Permian as a basin and compare, let's just say Permian was a country, the Permian just by itself would be number 3 in the world as a crude producer. So you obviously have, the Saudi Arabias and the Russias of the world, but shale revolution has transformed the oil landscape of the US energy marketplace. And by 2024, if you focus on that chart right there, we are going to be the largest global producer. Now that has huge implications, not just for the oil markets, the pricing, but also for the infrastructure needs of the country. So obviously, we hear about all the pipelines that are going in, not just in the oil space, but in the gas space as well. A lot of investments being made in the terminal side, so export terminals, storage. But all this oil and gas growth will need a lot of infrastructure to move. Obviously, oil can move in the back of a truck, but gas certainly needs pipes to move from the supply source to the market. So, a huge change in terms of the energy landscape thanks to shale revolution. So let's talk about pricing a little bit. So obviously, the shale phenomena only works if prices are supportive. So when you saw back in 2016, when prices dropped to below $40 a barrel, we did see a slowdown in shale drilling. Obviously, shale producers need a certain level of pricing to make the numbers work. And the number is somewhere, depending on what basin you're talking about, the number is somewhere between, let's say, mid-40s to $60 a barrel, depending on the basin you're talking about. Obviously, the Permian, like I talked about with a multi-stack play, is on the sort of longer cost side of, it's on the lower side of the cost stack, but the Eagle Ford and the Bakken is on the higher side. But anywhere between mid-40s and 60s is kind of the sweet spot for the shale producers. So what's going to happen in the future? If shale is going to be such a dominant phenomena in the global crude landscape, are we talking about a marketplace where prices are going to set by US shale break-even costs? But in general, this slide, what it shows is how the pricing environment has evolved. So obviously, what you have in the red is your WTI prices. And what you have in the blue is your surplus stock. So if you talk about what moves pricing in the global marketplace, what we've seen in the last 5 years from 2014, which was when oil prices crashed, to right now, what really the market is responding to is the surplus and deficit of stocks. So if you rewind all the way back to 2014, the first time prices dropped from like the high 90s, $100 a barrel, to down to almost like $40 a barrel, was the fact that the market was truly sort of responding to the fact that US shale was here to stay. And US shale was not a small number. Back in 2014, we saw the early innings of the rise of shale, 500,000 barrels per day or so. But then through 15 and into some first part of 16, we grew close to 1.5 million a year. So the market really sort of started to recognize the impact US shale was going to have on the global marketplace. And that got reflected in the blue bars. So the blue bars that you see here are basically your stock surplus, so global stock surplus over the 5-year average. And what that suggested was that US shale was basically oversupplying the market. So you see the correlation between the blue bars and the red line. Basically, the blue bars go up, the red lines goes down. And it's followed a fairly correlative pattern. Now, we've come to the point where global stocks are back to the 5-year average. A lot of variables went to work for that. OPEC cut production, we've all heard the stories around that. Demand fairly responded well to low prices of 2016 and 17, so we saw a big sort of demand upside globally. But really the situation now is, the current situation now is that all the stock surplus that we have been worrying about for the last 4 or 5 years has basically gone away. So the market effectively is in rebalance, but the market is still not out of danger zone yet, and we'll talk about that a little bit. But this is really what has helped the market balance. So if you look at one of the major factors that has led to the market balancing phenomena, it's been the fact that OPEC production is still a large part of the global crude supply mix. So if you look just overall numbers, OPEC production is anywhere between 30 to 35 million barrels in a 100 million barrel market. So obviously, any sort of reductions in supply, given that anyway global spare capacity is very low, has a huge impact in terms of market pricing. So if you look at the numbers here, the first production cut that OPEC constituted was back in December of 2016. You saw that big arrow going down there. And prices, started their upward trend back then. And it kind of went all the way up till last year when there was some miscalculation on the part of OPEC, and we all have heard the story many times before. Last year was all about geopolitical supply disruption premium, Iran sanctions, the waivers happened, there was a little bit of miscalculation, and the market was oversupplied. Q4, we saw a huge swoon in prices. Prices came off again back to low 40s. And then OPEC corrected its course, cut production again, to the point where now OPEC supply is down more than what the market expected. So just rough numbers here. But last year, December 2018, OPEC said it was going to cut production by about 1.2 million barrels per day. In the first 5 months, we've seen a supply cut of about 2.1 million. So, it's a huge reduction and higher than what the market has expected. So obviously, prices have gone back to the 60s, 60-plus range. Now, recently, we have the whole trade phenomena, economic growth slowdown, bring prices down. But in general, what this is saying is that OPEC, as sort of a market manager, has played a very important role in getting prices up from the low 40s to the mid-60s. Now, it was just not an OPEC story, given the fact that, a lot of the global crude supply comes from a lot of areas that are not your typical garden spots of the world. So we're talking like Venezuela, Iran, Libya's and Nigeria's of the world. OPEC had a big hand in cutting production, but given all the stories we've sort of heard about financially distressed nations like Venezuela and Libya and Nigeria, that had a big role in terms of disrupting global supply as well. So it was partly sort of a function of an intentional strategy by OPEC to cut production, and they've done a really good job at that. But also, they had help from other countries as well. So obviously, prices sort of stuck in this range bound between $55 and $65 a barrel. But let's come back to the U.S. and talk a little bit about the shale producers. So obviously, if you are a shale producer and your future kind of looks like where prices are going to be somewhere in this $55 to $65 a barrel range, gas is not looking any prettier, somewhere between $2.50 and $3. Really, the way to survive is to become more and more efficient. So you see the numbers here. These are shale oil break-evens. But basically what we are trying to do here is contrasting 2014 and 2018 break-evens. And what you see here is that producers have got a lot more efficient over time. And basically when we say efficiency, we're talking about new technology, better well completion designs, higher horsepower rigs, walkable rigs, lower drilling times, better proppant use, better well spacing, all kinds of technology solutions that have made producers a lot more productive compared to 2014. But if you look at the numbers, 2014, the average break-even was somewhere between $70 and $80 a barrel. And since then, we've pretty much declined anywhere between 7 to 10% to the point where we're economic somewhere between $50 to $60 a barrel. So obviously a huge reduction in terms of break even, and the numbers will vary depending on which producer you're talking about. Obviously, bigger producers in the Permian will probably be in the 30s and 40s, and we've seen numbers as low 20s in the Permian. And then there are sort of smaller producers that have a high break-even. So the variability around the break-even is pretty large. But in general, we could say that even if the price environment for global crude stays at about $60 a barrel, we could still see U.S. shale production continue to grow. Maybe not like what we saw last year, which was close to 2 million barrels per day. But certainly, 1 million barrels per day is not out of the question in perpetuity. So the question is, if U.S. shale is continuing to grow at, let's say, 1 million barrels per day, where does it go? So the three demand outlets that U.S. shale can have are really, you can have more refined products, so you can shove more U.S. crude oil into the U.S. refining industry. The second being, you could back out your crude imports, and the third being crude exports. Now, the first two that I talked about, the refining and the crude imports, we've already done that. So between 2010 and 2014, when U.S. crude production grew from 5 to 10 million barrels per day, we've substituted a lot of the heavy stuff that we were running in our US refiners and sort of changed it to light crudes. We've done that. We've already sort of maxed out on that capacity. Crude imports, there are barely any light crude imports that are coming into the US. We had about 4 million barrels of light crude coming in back in 2020, 2010. Now we have less than 1 million barrels per day, and most of that is in the East Coast. But really, the big valve, the big release valve that will help in terms of balancing the US domestic balances is crude exports. So if you look at the graphic on the left, very similar to the trajectory that you saw in crude production, you see a trajectory that is reflected in the US crude exports. Obviously, if you remember back in 2015, there was a ban on US crude exports, so obviously we couldn't export a lot of our crude abroad. But since the ban has been released, we've seen a huge increase in terms of crude exports from the US. So the numbers are as high as, on a weekly basis, we have seen numbers as high as 3.5 million barrels per day. So what we are saying here is that US crude is now going to places as far as China, India, Singapore, Japan. South Korea is a big customer now, especially post the Iranian sanctions. But the numbers are huge. What it has also done is widen the TI Brent spread. So if you look at the TI Brent spread, Brent is a proxy for global crudes, and WTI is a proxy for US domestic crude. So basically what this is saying is that given the explosive growth in US shale oil production, TI has to be discounted that much more to help it to get pushed into an overseas market. So you see the widening of the TI Brent spread. It was fairly flat back in 2015. Obviously, there was a ban. But as used crude production continued to grow, the TI Brent spread has widened, which basically says that right now, TI is discounted about anywhere between $8 to $9 a barrel in the front. So TI is that much cheaper. So that only makes US crude that much more economic in world markets. And we think that's probably going to continue in the future. So this is an interesting chart, but what this suggests is, we talked a lot about US crude production, we talked about crude exports, but we have come to a point where by end of next year, the US on a net energy import basis is going to be a net US energy exporter. So, for many decades, you see the blue line, we were a net US energy importer, and this includes crude oil, refined products, NGLs, coal, and gas. So obviously what this is saying is, despite the fact that, we were a fairly big energy resource, our consumption profile was so much higher, and US is a huge economy as well. We have a lot of energy needs. US was a net importer for the longest time, and only when the shale phenomena started to happen did we see that blue line starting to come down. So we peaked at about 30 quadrillion BTU. I don't even know how many zeros are in there, but it's a lot of zeros. But basically, since the shale revolution has happened, we have been on this declining trajectory. Obviously, it makes sense, right? We talked about crude exports being about 3.5 million barrels. It's backing out a lot of the crude imports. And we'll talk about gas in a minute. But even on the gas side, we've all been through the time when we were talking back in, let's say in the 2000s, we were talking about building LNG import terminals and that being sort of the marginal resource. And now we're exporting gas, almost close to 6 BCF per day. The two markets that are not often talked about are refined products and NGLs. Again, we turned refined product exporters back in 2011. So even before we started exporting crude, we were already a net refined product exporter back in 2011. NGLs as well, if any of you in the audience knows about NGL pricing, very, very bad right now. LPG prices are very cheap. I'm sure a lot of the wet gas producers in the Northeast and some of the wetter basins in the country are not very happy right now. Because what's happening is, even though we're getting all this crude and wet gas, we're also getting NGLs as sort of a byproduct. So basically, everything is an oversupply right now. And it's helping sort of reduce the energy balance in the country. But if you take the projections that EIA has for the future, it's suggesting that by end of 2020, we are not going to be a net energy importer. On an energy equivalent basis, on a BTU basis, we're going to turn net energy exporter in 2020. Now, that has huge implications for pricing for the country as a whole in terms of how the markets are managed for infrastructure needs. We talked about that. We'll talk about it some more. But it's a huge dynamic change for the energy markets. At least some of us remember the energy price shocks of 73 and 79. And we're not saying here that prices are going to be much different, because in a lot of ways, the export phenomena has globally interconnected all the markets. But certainly it means that we're not going to be held hostage, say, to some of the commodities shocks that we've had in the past. So we are a lot more independent in terms of our energy needs now. So the question is, if U.S. shale is such a great thing, what about pricing? Do we see pricing being set by the shale molecule? And if producers continue to go more and more efficient, does the $60 barrel turn into a $50 barrel, and in 10 years it turns into a $40 barrel? So that's the question. So if you look at the 2030 balances shown here, but basically what this is suggesting is, and I'll kind of explain the bars a little bit. So the red bar is right now what the global current supply is. The next bar, which shows the 10 million barrels, is our estimate of an annual global demand growth of, let's say, a little bit less than 1 million barrels per day, accumulated over about 10 years. The decline rates is a phenomena that perhaps a lot of people discounted a little bit, but it's very important in terms of when you talk about long-term balances. And global decline rates is a very interesting number, and you can see numbers anywhere between 3.5% per annum to 6% per annum. Obviously, the shale, with its high decline rates, have accelerated the decline number a little bit, and pricing has a lot to do with it. So just to give you an example, back in the high days of oil pricing being in $90 to $100 a barrel, the global decline rate was as low as 3.5% per year. Basically, what that suggested was high oil prices, people were putting a lot of money in there, even their low-margin assets, meaning that declines were mitigated to a larger extent than what's happening right now in a $50 to $60 environment. So obviously, low oil prices means high decline rates. So the number right now has gone up from like a 3.5% to 5% per annum. So obviously what this is saying is pricing has a lot to do with the number you put in here. But we're going conservative, and we're saying, let's just say it's 3.5% per year, which means you have to replace, I can't see the number, but I think it's 25 million barrels of global declines have to be mitigated by new supplies. So you have 10 million barrels of demand, 25 million barrels of decline, meaning in the next 10 years, you have to have 35 million barrels of new supply basically balance the market. Now let's say you look at all the market forecasts for shale supply out there, and even though we talk about this robust shale supply growth we've seen, the fact is that shale declines really quickly. So just to give you an example, the first-year decline of a Permian well is, let's say, anywhere between 70 to 80%. What this suggests is to keep the trajectory growing, and we've all heard of the phenomena of treadmill, but basically what this is suggesting is, to have the same amount of growth year on year, you only have to drill that many more wells. So just to give you an example, if the Permian drilled 4,000 wells in 2018 to have an increase of about 1 million barrels per day, by 2030, if you had to have the same number, the number of wells had to grow by about 4 times. So you have to drill anywhere between 16,000 to 20,000 wells just to have the same trajectory to grow. So given that there are going to be constraints around the service sector, we certainly don't think that that's going to be an achievable phenomena, unless there's some new technology that completely changes that landscape. But if you look at the market forecast around crude oil, what this is suggesting is that 5 million barrels is the number that everybody thinks can happen. So obviously it's suggesting that the supply growth annually is going to decline. Obviously there's going to be other things happening around the world, but if you net out all these numbers, different numbers, it's saying that you still need about 17 million barrels of yet to find supply. So yet to find meaning you have maxed out your US shale, you still have to go out there, drill your deep waters, drill your conventional reservoirs, and you need 17 million barrels worth of stuff. Does it have a higher price point? Perhaps. If you look at the break-evens for deep water, for conventional reservoirs, it's probably on the higher end of $60 to $70 a barrel. So what this is suggesting is, given that the global crude markets is really a global market, and you need all this new supply that's not going to be met with U.S. shale, you certainly need a slightly higher point than the break-even of U.S. shale, so perhaps in that $60 to $70 barrel environment, which is a good thing because it suggests that U.S. shale will probably be economic for a very long time. Now, I'm sure you guys have all heard about the concerns around demand growth around EVs. So obviously, EVs is a very real phenomena. The numbers are coming in really strong, and even though we are, in terms of overall sales, we are less than 1% in the US right now, the trajectory that we're seeing lends us to believe that it's going to be a huge number, especially the post-2025 timeframe. So you see the numbers on the left, and this is not our forecast, it's a Wood Mackenzie forecast. But that suggests that, global EV fleet size is going to have a huge uptrend post-2025. And that has implications in terms of oil demand. So if you look on the chart on the right, it says that, let's say the average demand growth in the past 10 years or so has been about 1.2 million barrels per day. So that's the number we used in the chart on the previous slide. But if you take the impact of EVs on oil demand and transport, just the growth of EVs is going to have a hugely disruptive effect in the crude market. So by, I think it's, where's my glasses? By 2035, we're going to halve the demand growth rate. So we're going to go from 1.2 million barrels per day to about 600,000 barrels per day. So huge disruption just in the crude complex. So do you get to a point where the numbers start to really come off? So our view is that, pre-2030, it's probably not as disruptive, but post-2030, especially as EVs start to gain and become a larger slice of the overall fleet, global fleet, oil demand is certainly going to come down quite substantially to the point where crude oil demand in the transport sector will probably be nothing. So we're going from transport demand of about 500,000 to being zero. So EVs is probably a very disruptive factor in crude markets, especially post-2030. Let's talk about gas, which is probably of more interest to you guys. But if you look at consensus forecasts out there, we'll talk about the current landscape a little bit, but if you look at the future, and we have the Wood Mackenzie gas supply long-term outlook here, to just sort of suggest that if you look at where people think that most of the future supply growth is going to come from, Northeast is a big part of the equation. So you see the little dash box. It suggests that close to, we've seen 15 to 16 BCF per day of gas supply growth in the past 5 to 7 years. And we're going to see a substantially larger amount, about the same amount, come from the Northeast in the next 10 or so years. We're also going to see production growth from the Haynesville, from associated gas plays, the Permian, the Bakken, the Eagle Ford, but the Northeast continues to be a big supply source. Now, we disagree a little bit in terms of the view that WoodMac has put out, and we'll talk about why. But similar to the chart we talked about in the oil side, similar story here. The producers are all about drilling longer laterals, getting more gas out of the ground, and doing it in a more cost-efficient way. So on the chart on the left here, we have basins on the x-axis and break-evens on the left. And this is what it's suggesting. Again, the same story here. The producers have just gotten more efficient, and they need to get more efficient, especially if you see pricing right now, anywhere between $250 and $260. Obviously, not a lot of margin, but we are still producing a lot of gas. We'll talk about the numbers here in a little bit, but last year, in a $3 market, we grew about 8 BCF. In today's market, even with $250, we're again going to grow. 2019 is again going to grow 8 BCF per day. So obviously what this is suggesting is even with low prices, the producers are making some money to the point where they're economic to drill. The chart on the right is break-evens with and without transport cost. And on the crude side, it doesn't matter as much because the transport adds a very small component as a percentage of the overall cost. So on the crude side, just to give you a little bit of a comparison, transport can add anywhere between, let's say, depending on the basin, $1.50 to $3 a barrel in a $60 market. On the gas side, it can be anywhere between, let's pick the Northeast as an example because that's the one I want to highlight here. But to build a pipe from the Northeast to the demand region, which is mostly in the Gulf, one, it's very hard to do. And we're seeing some of the challenges associated with some of the pipes that have been in construction and have had a lot of legal challenges. But certainly the numbers can be anywhere between, let's say, $1 to $1.75. So in a $2.50 market, if you have to pay $1.75 in pipe charges, you're basically not making any money. So this is what gives us a little bit of a pause in terms of Northeast production supply potential, because not only the Northeast producers are far away from the demand region, so all the demand is in the Gulf, most of it anyway, 80% of demand growth that is expected is going to come from the Gulf. But not only are the pipes that are in the construction facing huge legal challenges, we've seen issues around ACP, MVP, which by the way, Nextera is developing. But certainly, if you're talking about a new pipe from the Northeast all the way to the Gulf, you can pretty much forget about it. The other way to get from the Northeast to the Gulf is you can build to the Midwest, and you could come down from the Midwest south. But the pipe charge on that is going to be exorbitant. So like I said, in a $2.50 market, even a $3 market, given you have, let's say, 75 to 80 cents of drilling and completion costs, you're basically not making economic sense. So to have a new pipe being built from the Northeast to get all the way to the Gulf is getting a lot more complicated in this new era of tighter permitting challenges. So obviously, if you look at that graphic on the right, what that is suggesting is that most of the incremental gas, given the limitations on Northeast gas, are going to come from places that are closer to the Gulf. So obviously, we talked about the upside potential of Permian gas, Eagle Ford gas, but Haynesville has seen a new lease of life. So many of you remember back in 2010, 11, Haynesville was a big growth story, right? I mean, we peaked out about 9 BCF per day. And then as prices started to decline from the $6, $7 BTU world to like $2, $3 MMBTU, Haynesville saw a huge decline as the producers had not caught up to the whole productivity improvement phase. But Haynesville has seen a huge new lease of life. We have seen production once again peak at higher than the previous peak. So Haynesville has gone from 9 BCF to 6 BCF all the way to 10 BCF again. So that just speaks to how productivity, technology improvements can completely change the outlook for some of the plays that were previously forgotten. But again, the point here being transport cost has a bigger impact on gas than it has on the oil side. So remember that. This is a slide that again speaks to the sort of a more bleak outlook for Northeast production. So if you look at the resource in the Northeast, obviously the Marcellus and the Utica are very low-cost resources. We've all heard the numbers. The bigger producers always talk about 50-cent gas at the wellhead. But often what they do not talk about is how much does it cost to get it to market. And a lot of the pipe expansions that have already happened have been sort of the low-hanging fruit. So, a lot of the greenfield, the phase one that you see here, the round one, has been a lot of the brownfield expansion. So little reversals that have happened on the existing pipes. And some new pipes have come online, Nexus, Rover, in the past few years, that have added to capacity and have really allowed Northeast gas to flourish. To the point now, Northeast is somewhere about 30 BCF of gas, almost close to 40% of the US supply mix. So obviously a huge number, but in the future, the question is, will there be a round three? Once again, I don't want to belabor the point, but huge permitting challenges we're seeing with MVP, ACP. The question is there enough margin in the future in a 250 world to make the pipes work? And we certainly think that it's going to be challenging for the Northeast producers. The resource base is there, it's low cost, but getting it to market where it needs to be will be more complicated in the future. So here is a little bit of a near-term story. So, I talked about the 8 BCF of growth in 2018, even in a pretty low price environment. And even in 2019, really what the Northeast producers have figured out, and if you look at the share price performance of some of the Northeast guys, it's not been good. And in general, the E&P sector has been out of favor in the markets lately. But especially the Northeast guys have taken a big hit, and you can look at EQT, Antero, all these guys. Huge hit in terms of share price performance. But really the question, the market is kind of coming to the realization that despite the fact that it's a low-cost resource, you really are stuck in a place where, to get out of that place, it's going to be very expensive. So the chart on the left here kind of speaks to that. So if you look at the Northeast as a whole, it's a 30 BCF market, but really the growth has come from the top 9 or 10 guys. So those are on the table on the right. But basically what the Northeast producers have said this year, if you hear the quarterly announcements, they've said, the markets have not rewarded us for production growth. So all the 7, 8 BCF of growth that we've given you over the last few years, the markets are not giving us any credit for that. Our share price is not reflecting it. So where is the value to the investors here? Should we be looking at another business model here? So this year they've come out and said, we're not going to go after production growth. We're going to go after free cash flow. So we're going to drill less, we're going to produce less, but we are going to do it profitably. Now, they've talked about this many times before. Obviously, we've heard the story many times before. But every time we hear the story, we say, we call a little bit of bullshit to those guys. We're saying, if you look at these numbers, this is saying, last year they grew about 4 BCF per day. This year, given the whole production restraint story, they're saying we're only going to grow about 2 BCF. Well, all right, let's talk about this first. So, the question is, do the gas producers make any money? And this will tell you, no, they don't. So, obviously the pricing has a lot to do with it, but in general, if you look at the average free cash flows of some of the gas producers, and we kind of break it down between Northeast-focused guys versus multi-basin, which is more, it includes some of the oil producers as well. And lately, you've seen, in the right-hand side, you've seen a little bit of pickup in the Northeast guys because the basis in Northeast has improved. A lot of new pipe has come in. Some of the production restraint story is working. So the basis, which used to be as wide as $1.50, is now more variable cost, which is more in the 40 to 50 cent range. So the numbers have become a little bit better, but certainly if you look at the return on common equity, it's saying that the gas producers have not made money for a long time. So obviously, they have to think of something else. But initially in first quarter, we were a little bit confused because we have never believed this whole stop production growth story. And we were a little bit confused with the flattening of the supply profile that you see in 2019. So we were like, oh, maybe this year they're actually going to do something about it. They're really serious about this. We're not going to go 3, 4 BCF per day. So we were thinking maybe it's a bullish price environment. But look what happened here. So let me explain this a little bit. So in the red, you have pipe capacity. In the sort of dark black, I think, it's pipe scrapes. So what this is actual production. So we scrape all the pipelines, and we come up with the actual production number. The producer guidance that you saw in the previous slide, which was, we're only going to grow about 1.7 BCF per day, that's the yellow line. And then we have our own internal supply estimate, which basically what we do is we run a supply model, and we say, let's just say this whole producer guidance is conservative, and we're only going to grow a rig about, let's say, a rig a quarter, and we're going to put in some efficiency improvements, and we're going to come up with a supply profile. And we contrast that with the yellow line. So two things to point out here. One, the yellow line is already below the current production. So again, to the point, we're calling bullshit on those guys. The second point being that if you follow the green trajectory, 2019, again, is going to be a huge supply growth year. So 2019, we're again going to grow by about 4 BCF per day. 2020 is a little bit of a different story because 2020 is constrained by takeaways. So given all the delays we're seeing around MVP, ACP, producers are basically going to fill all the pipe by the end of 2019, and then there's no more new pipe. So what this is saying is, if you're interested in gas bases, is that gas bases in the Northeast is going to be relatively narrow in 2019, probably somewhere around 40 cents a MMBTU, which is a good story for Northeast producers. But ultimately, they're going to get smashed again in 2020. So basis, again, is going to widen to $1 plus in 2020, unless something happens and MVP or ACP comes online quicker. But certainly, the outlook is looking bleak in terms of actual completion of those pipelines, given all the challenges we've seen. Again, to the point, we were a little bit confused by the supply flattening in the front, but look again what has happened in April and May. We were at a peak of about 88 BCF back in December 2018. We're close to that number again. So a little bit of a dip, and then we're on sort of an upward trajectory again. And again, more recent numbers are closer to 90 BCF per day. So obviously, with better basis in the Northeast, producers are drilling more, adding more rigs, and production is showing up at higher and higher numbers. So the guidance means nothing. Don't go by the guidance. So if you sort of marry it all together, you take your forecast of Northeast production, which is a little bit constrained in the future in 20 and 21. You take your estimate of associated gas supply from all the oily basins we talked about. You come up with a number that looks like what you see in the green bars there. But basically what it's saying is, this again, 2018 was a peak year, right? Grew about 8 BCF. 19 again is going to be a huge year. But 20 and 20, we're going to see a slight decline in supply profile. So obviously what this is saying is that given the Northeast contribution is declining in the future, limited by pipeline takeaway, we are going to see associated gas being a bigger part of the supply mix in the next 3 or 4 years. Once again, just to sort of bring some historical context to it, the green bars are still larger than what you see in all the blue bars back in the historical years. So just to give you some context on the average there, average we grew in the blue bars, if you take out 2018, we grew about 2.5 BCF per day. All the green bars are still higher than 2.5 BCF per day. So a little bit of a context. We're not saying that we're not going to grow in terms of historical comparisons. Actually, we're going to go higher than what we've seen in the past. But in terms of 2018 and 19, certainly we're going to see a little bit of a slowdown. Let's talk a little bit about demand. So if you looked at what really sort of absorbed the U.S. gas supply in the past was the power sector. So power was the big sort of demand driver in the last 10 or so years. Now, moving forward, power will lose a little bit of its value. Still a little part of the demand growth story, but really the big demand story comes from the export sector. So much like crude and NGLs and all the other commodities, exports is going to become a larger and larger part of the demand mix. So the chart on the left is Mexico gas imports from the US. So obviously, a lot of pipes have been built from the Permian. Some from the Eagle Ford as well. NextEra owns the biggest pipeline that supplies gas to Mexico, the NET pipeline. It's a 2 BCF pipe. It's flowing full. NextEra is thinking of expanding it. But in general, the story being there's a huge demand market right next to us. And given the proximity of the Permian Basin to the Mexican markets, given it's easy to build pipes in Texas and Louisiana, it's basically suggesting that there's a huge demand potential. Now, we've seen about 5 BCF of gas go to Mexico. There are a little bit of delays on the Mexico side in terms of connecting the two pipes from the US side and the Mexico side. But the story being, it's a huge market. There's a lot of demand potential. If and when they need it, especially with AMLO and with more re-centralization of resources within Mexico, it looks like the demand upside might be a little bit limited, but it's a huge market and we are there to supply it if they need it. The other one, which is more interesting, is the LNG flows. So obviously, we've seen LNG flows almost up to 6 BCF per day. We have not forgotten the days when we were building 20 or so import terminals, thinking that imports were going to be the marginal resource, and what a turnaround it's been. Sabine Pass was the first one to start exporting in 2016. We've had Cameron, we've had Elba is almost ready, Freeport is almost ready, Corpus, there's one train running, Cameron is running one train. So a huge reversal in terms of the trend here as well. Now, the one thing we would like to point out here, in terms of daily demand profiles, LNG has a huge impact, especially in the Texas ERCOT markets, and this is more to do with basis. But given that LNG has become a huge part of the demand pie, especially in some of the Gulf markets, the days when we have disruptions or there's outages, maintenance outages, it has a huge impact in terms of balancing of the systems in the Gulf markets. But certainly the 6 BCF is going to be 10 BCF by the end of next year, so it's getting to be a bigger pie of the overall demand mix. But there are some questions. So if you look at whether US LNG is even economic, so what we are showing here is delivered US LNG cost, one to Europe, and I think, I don't know which line is which, but one is to Asia and one is to Europe. But basically, it's a netback. So what this is saying is, given global pricing of LNG and given what it takes to transport it to that market, are we making money as a US LNG shipper? If you look at the dashed line in the graphic, what this is suggesting is, given all the LNG supply that has come online in the last few years, so you see that big decline in netback that's been happening since the middle of 2018, it's a function of two things. One, LNG is very correlated to crude prices. So as crude moves, LNG prices move with it. And the other fact is that given that we've added 6 BCF LNG, the LNG market is oversupplied as well. So there's only so much potential for the market to absorb 10 BCF of LNG. So obviously what it has done is, and LNG is a very seasonal market, so the summer is typically the weak period. So in the summer, we're actually seeing negative netbacks for US LNG. So if you look at this year's LNG profile, we've seen huge amount of maintenance outages, whether they were intended or whether they were unintended. But it suddenly looks like this year we've seen higher than normal amount of outages that we've seen. So we've seen a huge amount of variability. If you look at a daily chart of LNG feed gas, it'll boggle your mind because it's not a straight profile. It's up and down. It changes every day. Just this morning, a news alert came out that 2 units were out again. So whether it's a maintenance, which is scheduled or not, it certainly doesn't look scheduled, but certainly it looks like some of these economics are having an impact in terms of how LNG is being priced and sent to other markets. So, as this number becomes 10 BCF, something to look out for, especially for us, fundamental analysis people, is how do you sort of account for balances, account for this variability in LNG demand in balances. Because 10 BCF in a seasonal market can have a huge impact in terms of your storage projections, in terms of your pricing. Right now, we're pricing at about 80% utilization, which is a pretty high number. But certainly, if the 10 BCF next year leads to weaker markets, that number could be as low as 60%. So, that just to sort of make the point that as we sort of go in the future, the LNG number will start to have a huge impact in terms of overall balances and price projections. So this is just, I'll quickly go through this, but this is just sort of speaking to where is the LNG going. So obviously you saw, in the early part of the LNG phenomena, most of it was going to Latin America. Obviously it makes sense, it's close to us. Mexico is a big part of the LNG story, given the sort of the constraints they were having on their pipe side. They were importing a lot of LNG at their Altamira terminal. It is a gas-starved nation, so their needs are really huge. But again, the pipes need to be there for pipe gas to be making a huger cut into their demand, into their supply mix. So in the meanwhile, they've been importing large amounts of LNG. So Mexico is a huge importer. Some of the other Latin American nations as well. Economically, it makes sense. It's right next to us. So transport costs are lower. Asia, so as we sort of push the boundaries of LNG supply growth story, so, growing from a BCF to 3 BCF to 6 BCF, we needed to start to push into sort of larger demand markets. So obviously, where's the larger demand markets? The Asian market. We started to make more inroads into the Asian market as well. Now we have come to the point where, everything is saturated. You saw that in the netbacks. Now we're basically dumping everything in the European market. So basically, we're pricing low enough that we're clearing in the European markets. That's not a really good story, especially if you're a LNG project developer. Right now, we're at close to 30 proposed projects. If you're a developer looking for a long-term contract, you're probably not going to get it in this price environment. So obviously, a little bit of a lull in terms of buying activity from the buyers. Not a super supportive story. But, let's forget about the short-term weakness. In general, if you look at the long-term prospects for US LNG, they look pretty good. So obviously, $2.53 gas really goes a long way in terms of producing a cheap LNG molecule. This just shows our expectations for what we could have in terms of demand upside in LNG. So obviously, the first 2 bars in 2021 are already under construction. So as you can see, we're going to get up to like 10 BCF. But there's potentially another about 6 to 8 BCF of LNG projects that might happen over the next, let's say, 10 years or so. But perhaps we've certainly seen a lot of FIDs happen this year. We saw Golden Pass. We saw Corpus Train 3. We've seen Calcasieu Pass almost get done. But certainly it looks like a lot of them are just sort of, like the Golden Pass was just a thing with Qatar Petroleum. They don't have any SPAs or heads of agreement with any LNG buyers. But they're more sort of portfolio players just taking it on their own book. So bigger players can afford to do that, but if you're a smaller guy like, pick another name like Calcasieu Pass or a Tellurian, you really need those contracts to make FID. So in a weak environment, that's not gonna happen. Perhaps, post-2020 is really the right time for some of these projects to make FID. Let's talk power. Once again, power was a huge demand source for all the supply growth that we're seeing, and all that was happening through coal gas displacement. Again, depending on the gas supply growth, basically power was taking up all the share of, through displacement, it was basically going up and down the supply stack. But if you look for the future of coal plants, what you have in the left here is our view of coal plant profitability. So of all the remaining coal units that are there in the US, we think almost about half of the existing coal fleet is out of the money. So all the red bars at the bottom basically are showing the darker red basically means they're very largely out of the money, and then as the shading gets lighter, they're less out of the money and the green are in the money. But basically it's saying that, we have retired about 50 or so gigawatts of coal in the past. We're going to retire another 50 gigawatts just based on economics, and this doesn't take into account any state-sponsored programs to keep these units alive. But if just the market economics work, about half the existing coal fleet are potential retirement candidates in the future, especially a lot of them in MISO and CERC, so the South Atlantic region, which again are coal-heavy regions, so that does not surprise anybody. Again, nuclear, the same story, very high operating costs of nuclear units. NextEra as a company announced the retirement of Duane Arlen in Iowa. So, we ourselves are facing some of the same issues that lower natural gas prices and the inroads of renewable are doing to some of the conventional fossil generation. Once again, you can see there, 45% of the existing nuclear fleet is out of the money today. We think there's a potential for about 17 gigawatts of additional nuclear retirement. So, fossil generation, given the cheap gas and given the inroads that renewables is making into the generation stack, is having huge impacts in terms of conventional fossil generation. And here's the issue. If you're looking at operating costs of power plants, and you're comparing it to the market prices in some of the major markets, so the lines in the red, green, and the purple, are basically round-the-clock average power prices in those regions. And basically it's showing the market pricing are reflecting that coal and nuclear are completely out of the money. So obviously Western PA, it's heart of PJM, where Marcellus and Northeast shale is a big supply source, so that doesn't surprise us. Power prices are very low. Indiana, again, does not have a capacity market, so it doesn't have the support of coal units having that capacity payment. So again, not supportive for coal staying alive, especially not the uneconomic coal. And Dallas, again, ERCOT markets, again, huge amounts of renewable in ERCOT market. All you have to do is go to West Texas and you'll see wind, and more wind. So, coal and nuclear is having a really tough time in most major markets. You can see the blue bars are all about the market power pricing line. So obviously, a tough road ahead for existing coal and nuclear units. And then when you talk about what are the utilities and some of the producers, power producers going to go for? So when you're talking about conventional forms of generation, so you're talking gas, coal, and nuclear, obviously we talked about operating costs of existing units. But in terms of power planning and capacity planning, when you're looking in the future, what are you looking at? So this is sort of cost per kilowatt hour post-2023. So we're saying, even if you don't take into account the ITC and the PTCs, obviously the ITCs are starting to phase out in 2020. We're going from 30% to 10% and then to nothing in 2023. But even with that, we think, and NextEra has a pretty good insight in terms of costs on solar and wind, We think even without ITC, and that's the number one question that our CEO gets asked, is do you think solar and wind will make it in the post-ITC world? And his story and our story is that with the cost declines that we're seeing on the solar side and with the efficiency improvements we're seeing on the wind side, wind and solar are going to be competitive even in a post-ITC world. And you can see the numbers there. Even with storage adders included, solar especially is becoming very, very competitive, even in sort of non-traditional regions of the US. So obviously, if you draw a line across the southern part of the US, kind of going from California, Arizona, all the way into Florida, those are sort of the sunnier parts of the country, and obviously there it makes sense to have solar, and solar will be very competitive there. I mean, we've seen, recently we saw Austin Energy sign a PPA for like $21 a megawatt hour. I mean, some really no numbers. Last year, Colorado Xcel Energy signed a PPA for like, I think, $27 or $28 a megawatt hour. So the numbers are really, really low, and certainly looks like the utilities are going in for a lot more solar plus storage. Storage adds anywhere between 5 to 10 megawatt per hour, depending on the market. But really what this is saying is that wind and solar are here to stay. I mean, solar with storage is a huge game changer, especially our CEO has said that solar with storage are in some markets, in the sunnier parts of the country, is going to obviate the need for any gas peakers. So even the peakers will not make any economic sense going forward. This slide kind of talks to the same concept. I mean, this is levelized cost of electricity for wind and solar. And the theme being this. So obviously, once again, talking about pre-ITC, post-ITC. But if you look at the trajectory of cost decline, it's been humongous. I mean, just the panel cost, the improvements on the efficiency, we've seen almost a 70 to 80% decline in terms of overall cost. So obviously, efficiency has really helped the solar story and the wind story as well, but certainly on the solar side, we've seen huge improvements. Now, we see that continuing in the future. So even with all the tariff talk, the rare metals issues and, all the storage stuff is going to need a lot of batteries. So, even with all that, we are comfortable in saying that, solar plus storage is continuing to be economic even in a post-ITC world. NextEra just announced a 400 megawatt Manatee Energy Storage Center. It's the biggest storage battery in the world. We are very proud of it. But certainly it kind of points to the dynamic that suggests that, we as a company and the country in general, we're seeing solar plus storage make huge inroads in terms of getting to sort of more conventional generation stack. And we're not just seeing it in the southern portion of the country. I mean, we've all heard stories about news reports about renewable portfolio standards. I mean, kind of states like New York and Connecticut, they've all signed up for lots of solar in the last 6 to 12 months. I think Connecticut signed for 1.5 gigawatts. NIPSCO signed up, I think, said 1.5 gigawatts by 2028. So it certainly is not a story that's limited to the solar parts of the country. We're seeing solar and storage make inroads into the northern parts of the country as well. So a lot of it is also supported by regulations, renewable portfolio standards, but certainly economics has a lot to do with it as well. So I guess sort of coming back to gas and talking about how this all sort of leads itself into gas balance. So if you look at the last 10 years, and looked at all the coal and nuclear that was retired, a lot of it was replaced by gas in the blue. So gas was almost close to 70% of the replacement generation. But if you look at the forwards, if you look at the next 6 to 7 years, gas is only going to replace about 30% of the lost generation from coal and nuclear. The biggest increase in terms of overall pie is going to be on the solar side. So we're going to gain a lot in terms of solar. Wind is going to gain some, but really, renewables as a whole is going to be a big addition in terms of overall growth. Gas is going to still be part of the supply mix, and it's going to gain a little bit, but certainly in terms of really the big growth is going to be in the renewable side. So renewables is here to stay. Renewables is economic. It's being supported by policy. But even in a post-ITC world, renewables are not going to go away. The efficiency we're seeing on the storage side, especially we're big in storage. We're trying to do more and more. We went from a 2-hour to a 4-hour battery. We're getting bigger. We're getting more reliable. We're getting to a point where we really sort of obviate the need for peakers. That is a big statement So obviously renewables is kind of something to look forward to. So just sort of kind of boiling it down into pricing. So obviously if gas is going to be plentiful, even though the trajectory is going down in the future, you were really talking about a market price environment where, it's not going to be super rich in terms of pricing. So if you look at our forecast for pricing in the next few years, we're really right on top of the market. So the market has kind of figured it all out. We're in somewhere between 250 and 270. It's a backwardated market. Obviously, the market is thinking there's enough supply even to meet the 10 BCF of LNG demand growth. Obviously, in the power sector, the renewables is taking a big bite out of it. So, the market price environment is not going to change anytime soon. We're going to be in a fairly weak pricing environment somewhere in that 250, 280 range. But once again, to highlight the point that there's still a lot of variability in terms of micropricing, especially when it comes to seasonal demand factors. So like we saw last winter, prices went all the way up to $4.50, $5, especially in some markets. So there's still going to be demand variability associated with all these demand factors, especially the seasonal ones through the winter. So be aware of that. But in terms of an overall average price outlook, we're going to be in a fairly muted gas price environment in the next few years. So not much variability there. I think that's it for me. It was a lot. I'll take your questions if you have any. Yes?
Meera, I had a question on crude. Are there other Permian basins, are there other Bakken shales in the world that we have yet to tap that will be a big part of the market going forward? And maybe some folks didn't hear that, but you just repeat that question.
Yeah, so the question is, are there any other basins that are out there like the Permian, right? Let me cough first. So I mean, if I knew that, I would be really rich, and I'm not. So, there's always the potential for some other resource, cheap resource being out there. So, the Permian is not a new resource. It's a 100-year-old field. It's been out there for a long time. It's only, when we got to $100 a barrel and shale was still around and people figured out that they could do something with this 100-year-old resource that, people started tinkering, and lo and behold, we're at a, 6 million barrel field here. So, nobody really knows. I think the shale potential is immense. So, perhaps in the next 5 years, they find another Permian resource. It's not out of the realm of reality. So, if that happens, then we're certainly in a lower price environment, but I think it's hard to tell. I think that's not out there yet, but to say that it will not be I don't think anybody can say that.
Do you think internationally that is a big opportunity? Do you see that? Maybe we don't know. But
Yeah, so a lot of countries, so the question is there shale opportunity internationally? So, a lot of countries have tried to do shale, so the big ones being China is a big threat. So obviously, given the fact that China is a huge demand resource, if they start producing their own shale production and they become as big as perhaps the US, then obviously they're not going to need imports, and China demand growth is the biggest demand market. So obviously if China is economic and they can find the shale resource, we, again, are in a lower weak price environment. But we've seen that, to make the shale economics work, you need a lot of different resources. We need a very, very sort of agile service sector. You need the water. You need the commercial structures that are out here in the US. And China has been very slow to do that, and some of their shale resources are in parts of the country where it's not easily accessible. They don't have enough water resources. So there are some limitations, but once again, to the earlier point I made, China pretty much can do whatever they want to do. It's a very state-regulated economy, so if the country's heads decide they want to do this, they're probably going to do it. So the resource is there. It's not for the lack of resource. It's just that the US service sector, the resources that we have here, there's just a culmination of all the factors that have sort of contributed to the proliferation of this industry, and China is not quite there yet. Anyone else?
What would the effect of the loss of various credits do to your projections with respect to the renewable portfolio? Because obviously they've had an effect on, the drop, the pricing. So what would, if those various credits would go away, how much would that curve maybe extend, or would it go away, or what's your thoughts on that?
You're talking about renewable credits?
Yes, the various tax credits and what have you with, renewable projects.
Oh, the tax credits. So once again, to the point where, our economic projections for the cost of solar and wind are that you don't need the tax credits. So given the declines we're seeing in terms of the panels and the efficiency, even after the tax credits go away, we don't think it sort of hinders the development. Obviously, when you look at the pipeline of solar and wind, it's all sort of front-end loaded. So a lot of construction going on, even in our company. 5 to 6 gigawatts in the next couple of years. A lot of developers are trying to meet the deadline of, getting it in before the 2020 phase down from the 30 to 10%. But, even with the 10%, it can continue till 2023. So there's a little bit of a time before it completely goes down to zero, especially on the solar side, which is really where most of the upside is. So, we as a company are certainly not worried about, we're a little bit worried, but we're not really worried. Because if the decline in costs continue, and we've seen even with the tariffs and everything else that's going on with China, we're certainly not seeing any sort of limitations in terms of either availability or in terms of pricing as well. So even if the credits go away, we don't think it's going to do anything to the supply stack. We think development is still going to continue. It's going to be interesting though, because it'll also depend on which company you're talking about. So NextEra, depending on the, given that the size and the magnitude of development pipeline that we have, we perhaps can get better pricing terms. So, we're probably in a better place compared to some other guys, some other developers, but in an overall sort of supply stack sort of story, I think we're probably gonna be okay even in a sort of post-ITC, PTC world. I can't hear you. I'm sorry.
Thank you. Which regions do you see the solar growth being the strongest?
Yeah, so obviously, like I said, if it's sunny, it's good. So we would all want to live in Florida and Arizona and California. I would like to live in California, except for it's very expensive. But obviously, a lot of these sunnier states are already very developed in terms of the renewable upside. So the most of the upside, really, is going to come from non-traditional regions, like I said, northern areas. So as we are sort of going down on the cost and getting up on the efficiency scale, we're going to sort of see the line move north. So obviously, Florida, Texas, Arizona, Colorado, California, already kind of there. We really don't have to push that much. But it's really when it gets to get into Indiana, PJM, MISO, even New England. The renewable portfolio standards are really high up there. So obviously, to meet that goal, even if it has to compete with gas or a nuclear unit, to meet that renewable portfolio standard, you have to build something. So. Part of the sort of extension into the northern territory is really supported by policy rather than economics at this point. In the sunnier part of the world, it's all economic. In sort of the northern parts, it's more policy. But like I said, as we get more efficient, that choice between policy and economics might be a very thin one. So we're seeing a larger and larger push into the northern areas. The southern areas are already pretty well infiltrated by the renewable resources. So we're going to probably see more inroads into PJM and MISO, and perhaps even New England. We've seen a solar plant in Vermont where it's barely sunny even a few months of the year. So, I guess that's it. Thank you, guys. Thanks for your time.